what trends we're seeing as it relates to the different segments of the economy. So Arun, where are we right now in the economy? What do you see looking forward?
Well, we're just coming out of a fairly short but a very sharp recession. So we're effectively at the beginning of the economic cycle. The last cycle, which ended at the back end of 2019, was actually the longest economic cycle the U.S. has had in the history. And the last couple of cycles have been quite long as well. So we definitely have longer cycles that last 8, 9, 10, or 11 years. So we're at the beginning of this cycle, which, if it's like previous cycles, could last 8, 9, or 10 years. The key difference that we have today, the key differentiation from previous cycles, is that we really have two parallel economies, the financial economy and the real economy. The financial economy is growing larger and larger vis-a-vis the real economy. Today, for example, U.S. credit markets are over $40 trillion in size, about $44 trillion. The economy is around 20. So the debt markets are significantly larger than the economy. A polite way of saying we simply have too much debt in the system. However, what we have are these very distinct feedback loops between the financial economy and the real economy. And of course, if we look at the Fed balance sheet, today it's almost 36% of the size of the real economy. So the Fed is actively using its balance sheet to manage the financial economy, which in turn is hoping it's able to support or direct the real economy.
But what do you see as it relates to monetary policy, interest rates, and really what does that mean to an investor?
Yeah, it's an important question because what we really see from the Federal Reserve are effectively the creation of distortions inside financial markets by artificially holding cash at zero, by buying assets, by interfering in the normal capital market activity. They distort prices, and it makes real price discovery much more difficult. So it's a bigger challenge this cycle than it was last cycle, as the Fed has been even more aggressive with its policy, and it's certainly acted faster than it did back in 08 and 09. So for investors, you really have to sort through what is a distortion, what's the true value of an asset, what's the longer term growth prospect, and how may the Fed or how may not the Fed impact or distort markets going forward in terms of what policy it may choose to act or enact. Inflation being one example where they have explicitly said they're going to run over target for a certain period of time.
What are you seeing just in terms of economic growth, and how does that translate into corporate earnings, and how bullish or bearish are you as you look into the future?
Well, the economic growth is definitely, the forecasts are quite strong for this year. There's actually quite a wide dispersion as well in terms of expectations, with many strategists looking for stronger growth. Some numbers as high as 6 or 7 or 8 or 9%. So the consensus is around 4 or 5, but there certainly are forecasts that are higher at 6 or 7 or 8%. And of course, if the economic forecasts are that high, that's certainly going to lead to a lot stronger earnings growth for corporations, and probably much more broadly based earnings growth than what we've seen in the last couple of years.
What sectors do you think win the most with this sort of a rebound?
So what we've seen from a sector perspective is some of those sectors that were the most beaten down, some of the cyclical sectors, some of the financial sectors, given the low rates, had all done very poorly. And those sectors have done better. They have stronger earnings growth and expectations going forward. So industrials, energy, financials, those have been some of the stronger sectors in terms of the earnings.
What high-level views do you have on the expansion of debt, expansion of the role of the Fed?
As well, there's huge sensitivity to rate movements. I mean, we have very, very low rates. So even if we go from what is very, very low today to still low by historic standards, because the debt is so high, that higher debt service payment will lead to a drag on growth as well. So now we're very sensitive to rising rates, both short and long term, and that's going to come out of future growth. So we're going to see much, much lower growth once we get through this period this year and into 2022. Once we go beyond that and the debt has to be repaid and rates normalize, we're going to see much lower growth, even possibly lower growth than we saw last cycle, which was historically low, or the lowest we've had.
Gosh, is now the time to be reallocating into small cap, and what's your view on that?
Yeah, so this has been a very, very sharp reversal for small cap in favor of large cap. It's faster than what we saw post 2000. And in 2000, it might have taken us 2 years to do what we did basically in 6 or 7 months. So it's a pretty quick reversal. I think at this stage, we've had most of the gains or the benefits for small cap. There still is an argument there's a little higher growth this year going forward, but a lot of that could obviously be priced in. So I think it makes sense for those investors that are overweight small cap to look at rebalancing, or to even look at some investors going underweight small cap. The fundamentals are not as strong when you look at margins and profitability and growth. The cyclical component is stronger, but the longer term growth numbers aren't there at the moment.
What's your view on this valuations?
Well, the key really is that everything is relative. So even though the PE multiples are high, they're not anywhere near as high as the cash and bond rates are low. So because rates are so low, that allows the PE multiple to expand. And in fact, if you go back to the early 80s when cash was 13, the PE was 7. So the earnings yield was actually about the same. You were getting about 13% earnings yield from stocks, and you're getting 13% from cash. So it was equal at the start of that cycle, which is a long bull run for equity. Today, you're getting nothing from cash. We're today at about 1.6, 1.65 for the 10-year, and stocks are yielding over 4.5%, which is a multiple right around 21. So we describe this as being fairly to moderately valued. We don't see this as being overvalued. Arguably, the PE multiple can run higher. And if you go back to 2000, when the multiple was higher, that was a very, very different point in time because cash was 5 and 6%, and the 10-year was around 5 and 6% as well. You actually had higher returns from cash in the 10-year than you had from earnings. So that truly was a distortion or a bubble, but that's not what we have today. So for many investors, the challenge really is to get the return they want. They have to take additional risk, typically in the form of equity exposure.
I just want to thank Arun for your research and thoughts and guidance on this. I'll turn it back over to Chris for any closing comments, and thanks everybody for joining us today.
Yeah, thanks Arun, thanks Craig for getting on to share your comments with us today. Just as a reminder, this research is available to you. We will give you the short form of this presentation that you just saw, as well as the complete quarterly market outlook once it becomes available in the next couple of days. And as I mentioned at the beginning, you are free to white label this research. Obviously we have to partner with you to do it, to share it with your clients, or you can take it as it is, share it with your clients.